In this video, I'm going to talk about the Warren Buffett investors call and three things about it. One is about him selling the airlines off. Two is about the $50 billion earnings loss that they reported. And three is his outlook on the economy and the stock market by what he did and what he didn't do. So a lot of that says a lot about what he really thinks about the stock market in general and the U.S. economy. So let's start with the first thing is he admitted that he sold off all of his airlines. And so I did a video about him selling Delta a few weeks back, and I said that he had a 10% stake, which is reportable. He has to report that in 2 days to the SEC. So he sold his limit, his stake, below 10%, which gave him the cover to go ahead and sell the whole rest of his stake in these airlines. And that's exactly what he did. And he admitted he sold them all off when he had just said 1 month earlier that he was not selling airlines. So that just goes to show you the scope of how quickly things have changed with, the shutdown in the economy and the effect it's having on the economy. So he's completely out of the airlines, and I guess licking his wounds from that and saying enough is enough, because there's no real clear expectation of when everything's going to get back to normal. So he said, hey, look, I'd rather just get out and on to the next thing, essentially. The other thing is this historical $50 billion loss that they reported. That is, it makes a nice headline, but it's not horrendous, especially if you're Warren Buffett, the way he holds stocks. Basically what it is this. The 5 top stocks that he holds are American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo. Okay, so the $50 billion loss is not because he sold any of those. He did sell some stocks though in the quarter, but anyway, it's not because he sold a bunch of stocks and realized a $50 billion loss. That's not the case. But the way the law is, they must report the mark-to-market stock value of his investments. So it's like if you bought Apple at 200 and it went down to 150, yeah, you got a 25% loss, but you haven't sold it yet. You're still holding it. That's kind of the same thing here. And like I said, 5 stocks are 70% of his stock holdings. And if you look at those 5 stocks, they did not do very well. So the best stock was Apple, that was only down 35% from its high to its low, while the other stocks like American Express was down about 50%, Bank of America was down about 50%, Coca-Cola was down about 40%, and Wells Fargo was also about 50%. And when I say these numbers, I'm talking about from their high during the quarter to the absolute low when everything sold off. Now, a lot of them have bounced back a certain amount since then, but as it stands, that's where his loss level is right now. And I think he has about $200 billion of stocks going into the quarter. So if he's down $50 billion, it's about 25% on his holdings. And that doesn't also count like the money's losing on Occidental and Delta Airlines and all the other airline stocks and whatnot. So that's what that $50 billion loss is all about. It's not great, but like I said, he didn't sell it all, so it's not like he has a realized loss. He's expecting these things to come back eventually. What's more important and more telling in my mind is a few things, and he touched on this in the call. One is, I don't know if, I didn't watch the whole call, but I don't know if he mentioned this, but he was a net seller of $3 billion of stock this year. So what that means is that when the market was going down like crazy, not only was he not buying it up, like he says, be be greedy when others are fearful and fearful when others are greedy. He wasn't being greedy when people were being fearful. He was actually a net seller to the tune of $3 billion, which is not a lot for him. So he could have sold, 10 billion and bought 7 billion, and that means he's a net seller of 3 billion, something like that, But anyway, so one, he sold more than he bought, okay, by $3 billion. And number two, and somebody mentioned this in the call, they asked him why he didn't buy back any Berkshire Hathaway stock when it fell, because it fell as low as like 30% off its high. And he said that, one, it happened very quickly, which is true. The bottom was kind of like a very quick down to the bottom and then a quick bounce up, so maybe he didn't have enough time to buy back a significant amount, but even a token amount would have, I guess, given confidence to other Berkshire Hathaway potential investors or holders. So I don't really buy that answer totally, but he also did say something about something that he didn't see the value in buying back Berkshire at this level. And what that means kind of is maybe he sees more pain for maybe the bank stocks he holds or something like that, or that the $137 billion in cash that he has would better be served by waiting for better deals that he can find, which will bring him a better return than using that cash to buy back Berkshire Hathaway stock. So I think that's kind of what he meant. And what that tells me is that he doesn't think this is the bottom of the stock market. And I don't think this is the bottom of the stock market. And so his actions, while he did say don't bet against America and everything like that, he didn't say don't bet against America and I just went all in with my 137 billion. He said don't bet against America, but I'm not betting more with America yet. He's like, I'm still waiting for some better deals to come, and then yeah, I'll bet with America, but just not yet. And so that's kind of what I want to tell people about, is this quick bounce up in the market. I don't buy it. This fall, we got 30 million people now unemployed, and the market has bounced up 30% since the unemployment rate has been skyrocketing up to 20%. And in the last recession, 2009, the worst unemployment rate we had was only 10%. So we're at like twice as bad as 2009, and yet we're only like 15-20% off of the highs. In 2009, the market fell a total of 56% from the high, and in 2000, the internet bubble, it fell 50%. Here, we only fell like 35-40%, and now we're only like 20% off of the highs. I don't think this is the end of it, and also I think earnings projections are still way too high, and our people are still too optimistic and thinking that they're just going to buy the dip and everything's going to work out. Another statistic is that the 12-month forward S&P price to earnings ratio is now about 20. And that means that's the expectation of the PE ratio for the earnings for the next 12 months. That's higher than it's been in 15 years. So do you think the stock market should be trading at a forward 20 PE when we have no idea what effect this shutdown is going to have on companies and how much longer it's going to go? I don't. And I think people are just kind of deluding themselves and want to think the best. But I think we really need to be realistic and be a lot more cautious and conservative. And so, for instance, last year, 2019, S&P earnings were about $140 a share. Now, this year, even if earnings are down, say 20% from last year, which is not unheard of, it's not crazy to think that, right? That would bring the earnings to $112 a share, let's say. At a historical PE of about 16, that would be a S&P of 1800. Okay, we're at what, 2,900 or something like that. That's a big drop from where we are now. And bear markets don't end with high PEs, they end with low PEs. So if we had a really low bear market bottom, the PE may be like 10 because people aren't willing to pay big multiples when they don't know what's going to happen in the future. So they're more cautious, so they're not willing to pay more than $10 for $1 of earnings. So if we had, say, a 10 PE on that same 20% drop off of last year's 2019 numbers, that would be an S&P 500 of 1120. Okay, that is what, 66% drop from where we are now. So I don't think we're out of the woods, and I think Buffett really kind of telegraphed. I know he was trying to be positive and all, but I think he telegraphed that he doesn't believe it either. And even his partner Charlie Munger, who wasn't in the interview this time, said in an interview like a week or two ago that not only was Berkshire Hathaway going to close some of the companies that they closed down for the quarantine, some of them are not going to reopen. And I don't mean like Geico or some huge company, but you know, some of the small marginal stuff, they may not even reopen it. They may just shut it down. That's not going to have an effect on their earnings. But what I'm saying is, even Munger expressed that this is something that they haven't seen before, and they're not trying to go out there and pick up the gold that's falling from the sky. They're trying to batten down the hatches and weather the storm and see what happens on the other end. So they're not out there, hey, let's buy everything up. They're more like, whoa, I never seen this thing before. Let's protect what we have and be careful and cautious, and you know, take the time to see where this ends up, and then we'll worry about making money. Right now we're just trying to protect what we have and you know, do that and survive the storm. So a lot of cautiousness all around with Buffett and Munger. So that's my thoughts on this conference call. And you know, like I said, I don't think this is the bottom of the stock market, and I don't think Buffett thinks it. I don't think Charlie Munger thinks it. And the earnings expectations are still way too optimistic, I think. So if I was you, I would not go all in. I'm not going all in. I'm still all cash right now, and we'll see what happens. Maybe I'm wrong, maybe I'm not, maybe it's somewhere in the middle, who knows. But I would be cautious. As usual, don't go all in on everything. And like he said, when somebody said that Berkshire Hathaway has been trailing the S&P 500, he said, look, in my will, I say put 90% of my money in the S&P 500 ETF because it's diversified. You don't know what company's going to win, what company's not. Stick to broad-based indexes like S&P 500 ETF and things like that, because it's very hard to pick individual winners. And if you put too much on any one stock and it goes down like Occidental or Delta Airlines or something, it's very hard to come back from a 60, 70, 80% loss on your money. So stick to the index funds. Don't put all your money in at once, and be cautious out there. Don't think that it's just buy the dip, close your eyes, buy the dip, and you'll always make money. That doesn't always work, okay? And we're seeing that now. So that's my video on Berkshire Hathaway's earnings and their conference call. If you like this video, give me a thumbs up and leave me a comment if you do think that this is the bottom of the stock market, or if you think we have a lot more to fall. As always, please subscribe to my channel if you haven't done so already. Thanks for watching.